We choose between a lot of things: tea or coffee, cats or dogs, sleep in or cancel the plans you made. The list goes on, and somehow we always find ourselves stuck between choosing an option. If you're new to the world of investing, you may have faced a different kind of question. Do I put my money on stocks or cryptocurrency? Which is better? Well, you're not the only one dealing with this dilemma. This has always been a very hotly debated topic between investors. But don't worry, because we're taking one for the rookies here. Today, we're gonna put stocks and crypto head to head. We'll get into detail with the advantages and disadvantages of both. We'll even dive deeper as we also go through volatility, the risk of fraud, profit source, and if you're gonna hit like and subscribe. Just kidding. No, really, help us out here. Stick around till the end of the video because this might be just what you need to get rich. Stocks and cryptocurrencies are dramatically different investment assets. While both are generally liquid assets that belong in the speculative side of your portfolio, the similarities end there. These are very different types of securities and belong in very different parts of your portfolio. First of all, what are stocks? Stocks represent ownership in a publicly traded company. Each share of stock you buy confers a percentage of ownership in the company itself. You receive this ownership in proportion to the number of shares that a company has issued. In other words, with stocks, you're investing in real companies that have to release information about their financials, such as what they're working on, where their money's being spent, and how much profit they expect to make. A stock's performance over the long term depends on the underlying company's success. If investors don't prefer or like a certain stock, they can opt to sell it with a lower price, but really, the company has to go out of business for the stocks to be insignificant. Cryptocurrency, on the other hand, is a purely digital asset. This means that it has no physical component, but rather exists only as entries in an online ledger recording ownership. With crypto, you're just buying code, and the value of the coin depends on what someone else is willing to pay for it. This is because there isn't much information publicly available as with crypto, and it's much harder to gauge future values. Let's talk about the volatility of both stocks and cryptocurrencies. Cryptocurrency is possibly the single most volatile asset that you can invest in. This rings true for both the market and individual assets. Whether you try out Bitcoin or an altcoin, cryptocurrency is a whirlwind of an experience. Assets can triple in value and then lose it all within the span of 24 hours. Investors can surely make big bucks out of that, but many cry over lost money too. Individual stocks almost always have lower volatility compared to crypto, but it's still not stable. As a matter of fact, until crypto came along, shares in a single stock were generally considered the most volatile investments you could make. Since cryptocurrencies are generally not backed up by any asset or cash flow, it relies on sentiment becoming more favorable to push up its price. If traders decide that they no longer want to own a cryptocurrency, it could plunge to zero because in the first place, it's not backed up by anything. In terms of volatility, it's pretty harsh here, with cryptos rising and falling 50% or more in a year. Also, countries can potentially ban cryptocurrencies entirely, as China did in 2021. Crypto is relatively new, so it's not firmly established as an asset class at the moment. As risky as stocks can be, cryptocurrencies are way more extreme. But despite the random walk of individual assets, the stock market as a whole tends to be generally stable and predictable. It generally moves slowly and gently, so much so that big changes in the stock market as a whole make the news. Stocks are often volatile, but they tend to be less volatile than crypto. Individual stocks are more volatile than a portfolio of stocks, which tends to benefit from diversification. Stocks are better suited to investors who can leave their money alone and don't need to access it. Generally, the longer you can leave it invested, the better. Some stocks can be more volatile than others too. For example, growth stocks tend to fluctuate more than value stocks or dividend stocks. However, investors may shift from more aggressive stocks like growth stocks to safer ones like dividend stocks as they need to tap their money, like when they approach retirement. So if you're seeking a stable asset, an S&P 500 index fund is usually a safe bet. If you want a speculative asset, an individual stock is a good choice. If you want an extremely volatile asset, crypto can surely play that role. Now that we've discussed the volatility of both our options, let's talk about risks and safety surrounding them. This is like the risk of fraud or scams present on both stocks and cryptocurrencies. If you're having plans to invest in any market-based investment, you need to firmly consider your risk tolerance. You don't want to dive in headfirst without knowing what's underneath the water. So crypto remains largely an unregulated asset class. This caused the surge of potential assets for investors to explore, which can be incredibly great for aggressive portfolios. However, there's always a catch. Estimates suggest that roughly a third of all new cryptocurrencies in the market are scams. Most are either traditional pump-and-dump schemes or cash grabs for an asset that will never be released. Tons of investors have also been nibbled by loose enforcement of existing regulations in the market. It has become common for popular voices in the crypto community to swing the price of an individual asset with a single tweet or Reddit post. This kind of behavior rarely happens in the stock market, as doing so with a regulated asset is a crime. Now that we've covered that, let's move on to profit source. You can generally profit off stocks in two ways. First, you can have capital gains by selling your shares to another investor for more than you paid. Second, you can hold the stock and collect dividends if the company behind the stock chooses to make dividend payments. From time to time, a company may buy back its own stock, making a more guaranteed form of capital gains. Remember that profit can only be collected through capital gains. While utility tokens offer a complex series of software solutions, ultimately any crypto on the market can only be turned into dollars by selling it to another investor. This makes cryptocurrency more speculative than stocks tend to be. A pure cryptocurrency ultimately is only worth what the next investor is willing to pay for it. There is no underlying asset to influence or stabilize that value. This means that cryptos are subject only to technical analysis. Stocks, on the other hand, have a grounded asset in the form of the company behind the shares. This makes room for fundamental analysis on a stock's value, as you can evaluate what the underlying company is worth regardless of market dynamics. So, bottom line, what should you invest in? Now listen closely, especially for the beginners. We think it's best to match it with your current financial and emotional state. If you've never invested in stocks before, you'll most likely to be overwhelmed when you get a 10% drop in your portfolio. It's good to remember that you need to get used to the waves of emotions that come with investing. If you don't become almost void of emotions towards your money, you're most likely to make bad decisions such as panic selling. We recommend you to invest in stocks first until you build up that ability to emotionally disconnect with money. This comes with time and it's a learning process. The reason why we recommend investing in stocks first is that in general, they're not subject to the same price swings as cryptocurrency is, so it's a much less volatile environment when you start investing. Because as you know, investing in cryptocurrency is like a walk in the park, only it's Jurassic Park. So once you feel less emotionally connected to your money, you can go ahead and venture into crypto. Well, that's our final verdict. However, our thought in this subject is not a case of one over the other. People should work up to the point where they have both crypto and stocks in their portfolios. By this, you're promoting diversification in your investment strategy. Which do you think is better? What would you invest in? Let us know in the comments below. Anyway, if you found this video helpful, do leave a thumbs up and hit subscribe. Until then, we'll see you in the next one.